Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Monday, 1st December. Coming up on the show, after record online spending on Black Friday, hopes are high for Cyber Monday. President Trump says he knows who the next Fed chair will be. And cryptocurrencies are falling heavily again. I'll explain why. So grab your coffee and let's own the morning. The first thing you need to know is that hopes are high for a record Cyber Monday. Why? Well, Black Friday retail sales soared. American consumers spent $11.8 billion online, according to Adobe Analytics. That's a new record. And analysts are hopeful that Cyber Monday will be even bigger. Reuters predicts $14.2 billion will be spent. Deals on electronics are set to peak today with up to 30% off average listed prices. The next thing you need to know is that President Trump has decided on his next pick for Fed chair. He's made it clear he expects them to deliver rate cuts. White House National Economic Council Director Kevin Hassett, Trump's chief economic advisor, seems to be the frontrunner to succeed Jerome Powell. And the last thing you need to know is that we have some key earnings out this week. We have updates from the world of retail with Macy's. It's expected to post a quarterly loss of 14 cents per share, a fall of 450% from a year ago. In the world of tech, we hear from CrowdStrike. In its Q3 results are likely to benefit from the robust demand for its cybersecurity products, given the increasing number of threat incidents across the globe. But overall, it is a busy week for earnings and also economic data coming up too, as my colleague Jared Blickery explains.
Time for What to Watch Now. Starting off on the earnings front, we'll be getting a big batch of earnings, including reports for Salesforce, as well as value retailers Dollar Tree and Dollar General. Salesforce announcing results for the third quarter on Wednesday. Analysts expecting Q3 to look a lot like the previous quarter, with solid growth, steady demand, and only small changes in profitability. The company's new acquisition of Informatica should help boost revenue over the next year by roughly $1.7 billion. But spending more to grow its Agentforce AI product could weigh on profit margins. Taking a look at the economy, the Fed's preferred inflation gauge is coming out on Friday. That's personal consumption expenditures, or PCE. Economists forecasting total and core PCE, which takes out food and energy, to hold steady at 0.3% and 0.2% respectively on a month-over-month basis, signaling that overall consumer prices are rising, but at the same pace as a previous month. And shifting gears to autos, auto sales data is out on Tuesday. Wall Street anticipating that number to come in at 15.4 million for November. It's a small but positive uptick in demand for new vehicles compared to the prior month, suggesting that consumers are still buying cars at a steady pace.
Well, here's how bad the crypto sell-off is and why. Well, after the worst monthly decline since 2021, just look at Bitcoin today. It's down over 5%, trading below $87,000. In fact, below $86,500 there. But the world's largest cryptocurrency isn't alone. Ethereum, Solana, and Dogecoin are all down sharply too. Investors, well, they're basically in a risk-off mood when it comes to crypto. But why? Well, number one, the inflows into Bitcoin exchange-traded funds has started to slow, and slow pretty dramatically. For much of 2025, the inflows into these ETFs has been on the rise. Number two, last week, S&P Global downgraded an assessment of the stability of the world's largest stablecoin, USDT, to its lowest rating. And number three, on Saturday, the People's Bank of China warned about the risks of virtual currencies, including stablecoins. It said that government agencies should work together to crack down on illegal activities. Okay, let's dig deeper into all of that now with Ethan Devitt. She's Senior Investment Advisor at Moneta, and she joins me now. Ethan, thanks so much for joining us. Let's start with crypto. Pretty dramatic falls. It's had in October, we were talking about 126,000 for Bitcoin. We're now in the 80s. Is 80,000 the next sort of target?
Well, it's definitely had a fairly torrid run. And the interesting part is that this all seemed to be sparked when we had the last round of US-China trade tensions. it was quite apparent that Bitcoin did not like that for some reason. And that really was the bellwether then for a risk off that we saw throughout much of the month of November, even though perhaps the month was about flat for markets. That really masked quite a bit of volatility in equity markets. And as you said, this does seem to be at the most extreme end of risk tolerance for investors. And right now, the uncertainty is just so high. And equally, this seems to coincide with when large pension funds have announced their block holdings in Bitcoin. When it has reached the mainstream, it seems just at this point seems to be the point perhaps for many investors to decide enough is enough.
Now, we've just had Black Friday. We've got Cyber Monday today. Things are looking good for retail, no?
It's interesting. We're in a good news is bad news is good news conundrum. And what I've heard actually around the spending is this spending affordable? Is it tenable? Is it going to coincide with an increase in credit card debt? Is there a sense of exuberance, this spending before perhaps inflation gets around the corner? And has this all been brought forward essentially into 2025? Because remembering most of the tariffs were not yet passed through. So even though expectations around inflation are quite divergent, a significant amount of the population does expect prices to go up. So I would suggest it's a little bit of that, and it could also be at the expense of bricks and mortar stores. So let's see what happens, but I'm not necessarily reconciling that with the weak sentiment I saw around consumer sentiment.
Well, that brings us on quite nicely to earnings, because we hear from some of those retailers. We hear from Macy's, Dollar Tree, Dollar General. I mean, Macy's is an interesting one. What should we expect from them?
It's interesting. This is, I suppose, a surprise turnaround, certainly going against the grain and the trend in terms of big box stores and department stores in general. It does show that a perfectly executed and well telegraphed strategy that is shown to be very sensitive to cost overruns and strategic and executed well, that will be rewarded in markets today. Markets are searching desperately for other ways to shore up this demand for equities other than the usual suspects of the top 7, top 10. There is a desire to build more breadth into markets. And so I see retail, there have been perhaps some wishful thinking around some of the retail. And we also just had the Thanksgiving parade as well. One of the flagship Macy's events, that went off very well. So I'd say definitely sentiment is building for a positive expectation around the current announcement, certainly of a streamlined turnaround.
And AI is obviously never far from the headlines. We hear from Salesforce as well. We're expecting good things from them, no?
I'd say that this is really at the juxtaposition of what we're seeing in terms of AI, discriminatory spending by enterprises, and essentially over-promising, under-delivering. It's a really interesting example of what, for example, any kind of customer software can deliver. What we've seen is that often the take-up, the use case for this type of software is not nearly as much as professed. There are a lot of glitches. We hear a lot about people not getting the most out of it, perhaps a desire to transition to others. And that's where we've seen the competition really encroach upon Salesforce's share. And I'd say with the AI substitution that we're seeing, this is a real concern for them. We know they have embraced AI, but there's still some concern that they're not going to be able to maintain their position. So I think this is really going to be an interesting petri dish as to how other software providers can really survive in this age of AI.
Ethan Devitt, as always, many thanks for your time. I'm afraid that's all we've got time for. Ethan Devitt there from Moneta. Okay, we're heading for a short break now, but when we return, I'll have the finalists for Yahoo Finance's Company of the Year. Stay tuned. Welcome back. So, who will be crowned Yahoo Finance's Company of the Year? Well, this year, when our panel sat down, they all agreed that the winner must be super grounded in artificial intelligence. So, the three contenders for our 11th annual Company of the Year award are OpenAI, Oracle, and Nvidia. Over the next week and a half, we'll preview each of these companies live on Yahoo Finance and discuss why they are in the running to take home the crown. Well, here's our executive editor, Brian Sozzi, and his panel, and they're all in agreement about who they believe should win it. But are they right? Well, take a listen.
I have to say NVIDIA, because it just has been at the center of all these deals, because it's been at the center of the AI chip space, and it's been the one that's driving. I mean, if you look at any earnings report that comes out, NVIDIA is the one that is the bellwether of them all, and all eyes are always on NVIDIA.
Michelle, over to you. Now, I will just say, I can make a pretty good case for Oracle. I think a lot of people forgot about Oracle up to September when it came out with that big backlog that really shocked a lot of people that I talked to.
Well, yeah, I mean, Oracle is definitely a contender, and you can see that it's been under a lot of pressure right here. But in terms of if you're asking about of the three companies you mentioned, I'm going to go also with Inez here on NVIDIA. But I would keep an eye on Oracle. I mean, again, these big companies that have these massive corrections have turned out to be buy opportunities. I just think it has to be somewhat of an astute technical analyst that's really going to be able to come out and say, okay, this is the bottom. Like, are we at the bottom at around 175 in NVIDIA? Well, I would look at that as a potential. And so I'm going to stick with NVIDIA too. Oracle has been way too volatile.
All right, we have two giving the crown to NVIDIA. Dana, over to you.
I really wish I could give you some diversity and variety here, but I don't know how you go with anybody but NVIDIA in this market after what's happened this year. Now we'll see next year. You know, I think we're all kind of actually a bit relieved, right, that there's some, diversification among the providers and the Google deal. But at the end of the day, if you're talking about a company of 2025, just look at the trajectory of that stock. It's sort of hard to make a case for anybody else.
So, do you agree with that assessment of NVIDIA as who should win the crown? Or do you think it should be Oracle or even OpenAI? Well, let me know. You can send me a tweet on X. I'm at Ramzan K. The winner will be revealed on the morning of December 8th on the Yahoo Finance homepage and app with a full day of live coverage. Okay, we're heading for a short break, but stick with us as we'll have your trending tickers and also a call of the day on the S&P 500 in 2026. Time now for today's trending tickers, and these are the stocks that are making moves in early trade. We start with global aviation. After 6,000 planes had to be temporarily grounded during Thanksgiving weekend. Airbus shares are down more than 8.5% after the company alerted down more than 10% now after the company alerted airlines on Friday that most aircraft from the A320 family needed a software update before they could fly again. Authorities around the world helped ensure minimal disruptions for passengers, but the fact that planes had to go back to older software and about 1,000 planes may also require hardware replacement before they can fly again highlights the fragility of the global air travel system, which vastly relies on the Boeing-Airbus duopoly. Aviation experts stress that this also demonstrates how important safety and prevention measures are in the industry. Now, onto another industry that's grown vital for so many businesses around the world, cloud computing. In recent weeks, we've seen all sorts of outages rippling through global markets and supply chains, from the Chicago Exchange to ChatGPT and websites around the world going down, causing total damage estimated in the billions of dollars. Now, Google and Amazon say they may have new solutions. It's called multi-cloud networking. In a joint statement, the tech giants say they will now be able to quickly establish private, high-speed links between their respective computing platforms, effectively offering more safety nets and allowing customers to move easily between the two platforms. Well, while we're on tech, make sure you keep an eye on Intel today. The chipmaker rose more than 10% on Friday on speculation that it may start soon producing new chips for Apple. Finally, let's take a look at defense stocks before we go. Even if Germany and other countries have reiterated that they are increasing defense budgets, some of Europe's largest names are deep in the red this morning. This comes off the back of a weekend where talks continued around how to end the war in Ukraine, with Marco Rubio saying there was some progress and the US sending its representative to Moscow this week. And even if a deal doesn't seem imminent, many investors think it's time to take in the profits after a strong rally. So, while some investors are reducing their exposure to risk in sectors like AI and defense, healthcare is one industry that's seeing significant inflows in this end of 2025. Equity strategist Jared Holtz explained why to my colleague Julie Hyman.
Well, I think first and foremost, it's just been the breadth of the market and money coming out of some of, these perennial winners, namely large cap tech, think when, I speak to healthcare investors, one of the biggest things that we kind of discuss in so many different forums is just the momentum of tech and the underperformance of healthcare that's been so consistent. So for the first time all year, you finally saw some of that dispersion happen, or some reversion rather, into healthcare. I'm not really sure that anything has changed significantly, but I think enough people are talking about the fact that the companies seem more comfortable with the regulatory environment more broadly.
And when you look at what has done well within the group, a lot of it is drug makers themselves, a lot of it is device makers as well. It's not so much the insurers, for example. And do you think, is that fair to say? And what are the dynamics that have driven kind of the subsectors within healthcare?
Yeah, I think when you look at the insurers and the managed care subsector, two things really come to mind. One, there's been sort of this on again, off again situation with respect to the exchange subsidies and whether that was going to be part of the agreement that got the government back up and running. So far, there's been no definitive answer on that, but it seems like there will be an extension. I mean, that's what most of the reports suggest. But again, it's been a little bit inconsistent as far as the news flow there. I think that's been a little bit troubling for some investors to wrap their heads around. The second thing would just be that we're seeing, utilization stay stronger for longer. That goes back to your comments around the medical device stocks. They've been fairly strong. And if they're strong, you shouldn't really see managed care play to the same tune, meaning if one group is strong there, the other should not be as strong, as these are the companies that kind of pay for those procedures. So we've seen a lot of strength in pharma and medical devices because of the utilization situation. And then managed care has kind of lingered. The stocks have not been bad necessarily, but they have not really caught this momentum trade.
Do you think that will change for managed care?
I don't really see anything changing dramatically with managed care into next year. I still think utilization is going to be pretty solid next year. I mean, the economic data has been fairly strong. There's been a lot of new products that have been launching across different categories within devices. Obviously, the GLP-1s, if they continue to exceed expectations, and now you've got the orals coming to market, some of the pricing dynamics, I think, help managed care. But on the flip side, if volumes continue to expand like a lot of people around the street expect them to, I'm just not sure this group catches a major bid, but they're very cheap at the same time. So you have this dichotomy between whether the group is kind of sound fundamentally and whether they're cheap enough.
And do you think that, what do you think the prospects are for an extension of the ACA subsidies, either by the end of the year or at all?
It seems like it's sort of self-fulfilling. I just can't see politicians wiping out the subsidies with the midterms coming up and how important it is to so much of the electorate. I mean, when we talk about this group, a lot of it is always hinged on what is the senior population going to do. In this case, they're younger patients, stripping away insurance and having them go get it on their own. At this point, with a bigger out-of-pocket component seems unlikely. I know that the administration has talked about maybe curtailing the subsidies and instead, giving some of the population, some sort of payment in the form of a check or otherwise that basically bridges the gap between what they would have gotten and the subsidies going away. But I think too many politicians have their careers on the line. I would doubt that the subsidies get derailed completely. So I think we're looking at least a year, maybe two of an extension.
Tis the season for the stock market calls for 2026, and we're seeing some very bold predictions being thrown out there by banks. The S&P 500 will hit 8,000 points, according to Deutsche Bank's latest report last week, and the equity strategy team says the coming year will be one of robust earnings and growing valuations. That view sits at the upper end of Wall Street's expectations for next year. HSBC, for example, has a 2026 target of 7,500, while JP Morgan is calling for the S&P 500 to reach 7,500 with upside to 8,000 if the Fed continues to cut rates. Morgan Stanley also expects a strong year, forecasting the index will finish 2026 at 7,800, amid what strategist Mike Wilson calls a, quote, new bull market. Wells Fargo also sees 7,800, but they explain very well what the context is. Yes, the AI boom is set to continue, but the trade could become a bubble. Wells Fargo, like many other strategists out there, are betting that the current policies and liquidity should keep supporting stocks heading into the midterm elections. But they note the market is becoming increasingly intertwined with the broader economy. And if the jobs market or inflation don't go in the right direction, well, that could pretty much throw all of these predictions out of the window. Okay, before we go, let's check in on the markets and how they're doing today. Let's start with crypto, and the risk-off sentiment has certainly hit the world of crypto. Bitcoin falling now down, I think, around 6% there, or almost 6% there now, but all the cryptocurrencies are down. Let's move up to silver now, not gold for a change. Silver has jumped more than 2% earlier to a record high, with traders placing speculative bets given ongoing supply tightness and rising expectations for an interest rate cut in the US. Gold was pretty steady too, up as well, just below 1% there, 0.7% there. Let's move on to Asian markets now, and Japanese stocks led losses and the yen strengthened as the Bank of Japan Governor Katsuo Ueda sent the clearest hint yet that his board might raise rates soon, highlighting the possibility of a move at the central bank's meeting this month. Ahead of his speech, the 2-year bond yield actually rose to its highest since 2008. Now, a rally in metal shares helped Chinese equities begin December on an optimistic note. That's even as data published on Sunday showed factory activity improved, but remained in contraction in November, extending its streak of declines to a record as the country's economic slowdown deepens. Before we go into European shares, let's have a quick look at Airbus, just to remind you, shares there falling really heavily, over 10%. We've now got reports about quality issues on the A320, according to Reuters as well. So Airbus shares really under pressure. Okay, let's move on to the European boards now. And European shares have started the trading day deeply in the red there, as you can see, partly because of that Airbus issue, but also defense stocks have fallen sharply in early trade. Traders are keeping a close eye on whether a peace deal for Ukraine might actually happen. Now, let's have a look at US markets as well. And stock futures are sliding, with Wall Street's strong late November rebound. Well, it looks like it's hit a bit of a speed bump, as you can see on this first trading day of December. Okay, that is it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. I'm Ramzan Karmali. Go own the morning.